What is going on with gold? And are we likely to see less than $1,000 an ounce in gold before we see $3,000 an ounce? Hey everyone, thank you so much for watching Yankee Stacking. I love gold. Physical gold, as you can probably tell. I know it's down in spot price. I know it's below $1,800 at the making of this video. And I know it's confounding the gold bulls everywhere. I've talked about how I think we're in a buying opportunity for silver and how I'm continuing to accumulate the white metal, but I also see gold in a similar light. I got most of my gold back in 2009 when it was about $1,000 an ounce. That's when I was convinced we passed the point of no return with our profligate fiscal and monetary policies. $1,000 an ounce, not bad, but that was the Yankee Cannon. The other gold, a lot of the Canadian maple leafs, the fractional gold, some of these foreign pieces, I definitely spent more, $1,700, $1,800, $1,900 an ounce. But, when gold is $3,000, $4,000, $5,000 an ounce, I'm not going to care too much that I spent $1,800 or $1,900 an ounce. This 35 and a half plus ounces is definitely a strategic stacking goal of mine. And my ultimate goal is to reach 50 ounces of gold by the time I retire. It's, a good goal. I hope I actually reach it. But I think if you're not stacking physical precious metals, you're missing out. You need to do that. Gold and silver, both. And I'm buying gold on the way down, but I'm not selling it on the way up. No, I don't do that. I don't sell my wealth insurance. I don't sell my car insurance. I don't sell my life insurance. I'm not going to sell my precious metals wealth insurance. I don't think that's a wise choice. Now, this is the physical market, of course. I'm stacking and holding. When it comes to the paper markets, I do invest, insurance, investing. So I invest in gold and silver mining companies that I think are good buys, that are undervalued, commodity stocks that I think will appreciate over the next 10 to 20 years, especially in an inflationary environment. So definitely like to invest in mining companies. I'm going to interview the CEO of one of the royalty companies that I have watched very carefully. So let's listen to David Garoppolo and find out what's really going on with gold and gold royalty. Hi, David. Thank you so much for coming back for a second dose of Yankee Stacking.
I'm delighted to be here.
Since we last spoke in May, we've seen gold go from over $1,900 an ounce back down under $1,780. That's like a 7% decline. So I have to ask you, David, are we about to go into a gold bear market?
No, not at all. I mean, there's so much going for gold right now, including low interest rates, still quite a bit of quantitative easing going on, printing a fiat currency. That isn't going to abate anytime soon. We're in a period where, with all the sovereign debt strapped on, the governments have no choice but to debase their debt by debasing their currency. So that's a phenomenon that's likely to be entrenched for a long, long time, a number of years. The other side of the equation is on the supply side. And as I've told you and your viewers before, we're in an irreversible decline in terms of gold reserves globally. They're down about 40% from peak about 6 or 7 years ago. And even with any significant discoveries that might happen, and there isn't enough capital being invested in the ground for that to happen anytime soon, but even if there were a significant discovery, the lead times, the capital intensity, the barriers socially to getting new mines up and running means that we're in an irreversible decline in production for at least a decade or more.
Well, one of the other things that we saw since we last spoke in May was inflation. It soared, right? it prompted most market investors, most financial analysts, economists to believe that the Fed will begin tapering its $120 billion asset purchases, either this year or next. Is such a taper move likely, and is it sustainable?
There's no fiscally responsible way for the U.S. government, or for that matter, any government in the industrialized world, to repay the debt that they've strapped on pre, during, and post-pandemic. And so the only way to deal with that debt is to print money, debase the debt, debase the currency. So I just don't believe there's going to be any substantial tapering. And the inflation dynamic, we've seen the headline numbers north of 5%. That significantly understates real inflation. Have you bought a house? Have you bought gas? Have you bought food in the last year? It's not 5%. We're in double-digit territory. This is kind of hyperinflation numbers that we saw back in the 70s.
Well, we did get surprised with stronger than expected consumer spending. Retail purchases beat expectations in August. And then the dollar strengthened. And as you and I and everybody watching knows, gold and silver got whacked.
Yeah, and look, I think the dynamic driving that is the fact that general equity markets continue to achieve new highs every day. And gold equities are generally seen as a hedge against that. But look, there's likely to be a severe correction in the general equity markets given where the multiples have really distorted themselves. We're in unprecedented territory in terms of multiple earnings, cash flow, enterprise value to EBITDA, all those metrics that the market looks at. We've never seen these heights before. There's nothing to substantiate those types of valuation in the marketplace, other than the fact that the Federal Reserve and all the central banks globally have flooded the market with currency, and that currency is chasing hard assets, is chasing equities. But eventually there's going to have to be a correction, and there's nowhere to hide when that happens other than in gold. And when there is that reckoning in the market, that's exactly where you want your portfolio to be.
I agree. I think we're going to see a massive correction. Who knows? Maybe by the time this video gets posted, we'll have experienced it. But this is what makes me think that the markets are in a wonderland, okay? And it blows my mind. When the economic news is bad, then that's bad news for gold and gold stocks. Why? Because if inflation is printing higher, then everybody thinks the Fed's got to taper, and so that means that gold's got to drop, right? But on the reverse side, when the news is good, it's still bad for gold. The dollar strengthens, investors crowd into bonds, and gold goes down. When is this madness going to stop? When are they going to finally realize that it's a bunch of smoke and mirrors?
We're starting to see some strains in the system. With this Chinese real estate potential bust, there are definitely strains in the system. $300 billion of debt in one organization. That's
incredible.
There are countries that have a smaller economic activity than that company's carrying in debt. There are clearly strains. Balance sheets are overextended. Money has been perceived as free, and so people have just been raising money left, right, and center. But there has to be a reckoning at the corporate level, individual level. We can't sustain these kind of debt levels forever. What the catalyst will be a failure, a corporate failure like the one that's potentially going to happen in China, and that'll lead to a chain reaction. And it really undermines confidence in the financial system. And again, where are you going to hide when that happens? You're not going to buy US dollars. You're not going to buy Canadian dollars. You're not going to buy euros. You're not going to buy British pounds, because they've all been debased substantially. You're going to buy the one currency that can't be printed.
So in our May interview, you made a really bold statement about gold. Okay, you first compared the price of gold, I think it was in 1981, where you said it was $850 an ounce, to today. And you said that in today's dollars, adjusted for inflation, that $850 an ounce would be over $3,000 an ounce. You said, and I quote, "There's no reason we shouldn't be there at the end of this year, if not sooner." Do you believe that still?
I think this is months away from happening. And listen, when commodity prices go up, and gold in particular go up, they don't go up in a steady fashion. It's generally violent. And we've seen that, for example, in the copper market recently. Copper market was in the doldrums a year ago, and we've achieved new highs in copper in the last 6 months to a year. Yep. It happened quickly, violently. And so it's never a steady straight line up. It's generally violent price action with a lot of volatility. So, I just say watch the space. When it happens, it'll happen quickly, and it'll happen violently.
I'm still very bullish on gold and silver mining companies. I have been for months, and especially royalty companies. I think it's almost a no-brainer to find and get in on the right royalty. And we're going to discuss your company, Gold Royalty Corp. Last time we talked, I showed you the Yankee quadrant, and I applied it to your company. You've done very well since May, and most recently, I saw an amazing 28% rise in share value in like 1 or 2 days, back on September 7th. I noticed that move. I bet many of the more than 10,000 people who saw my first interview with you noticed that move as well. Would you tell us about the exciting acquisitions that drove such huge interest in Gold Royalty?
Yeah, no, that's an excellent question. I almost have to take us back to the beginning of the story when we IPO'd back in March, and we raised $90 million on the NYSE, and we got a post-money valuation of $200 million US. And what I said when we launched this is we needed to achieve scale quickly, because royalty companies are useful part of the ecosystem for mine development when they're able to provide capital or access to capital for the emerging explorers and developers.
Right.
But to provide capital on a cost-effective basis, you have to have scale. And what I saw was a landscape littered with small market cap royalty players that have come into the space over the last couple of years with a great idea, but no scale and no access to capital. And they're zombie companies. And so we've gone about consolidating them, rolling them up. And we've announced 3 mergers since our IPO in March. We completed the first one, Ely Gold, back in August, actually. We announced it in May and then completed in August. And we achieved a 35 to 40% re-rate in our stock as a result of that acquisition, because we achieved scale. We doubled our size overnight through that acquisition. And then shortly after completing that deal, we announced the acquisition of Abitibi Mining and Gold Royalties, and also Golden Valley Mining and Royalties, which collectively have another 60 or 70 royalties, and will allow us to double our size again when we complete that merger in November. So we'll go from a $200 million market cap to 400 with Ely to 800 with those acquisitions. And we'll substantially diversify our royalty portfolio. We started with 17 royalties in our IPO. We're going to have 191 royalties when we complete this latest acquisition.
Wow.
6 of them in production, 7 of them in construction, and then a very, very significant pipeline of over 180 royalties from exploration stage to feasibility, which means we're going to have organic growth in our cash flow for the foreseeable future, for years and years to come. And in fact, over the next 3 to 5 years, we expect to see our cash flow quintuple, go up 5-fold. So that's a great upward trajectory. We've achieved scale through these acquisitions. We've lowered our cost of capital. We're achieving a re-rate, which means we're going to be competitive for new royalty opportunities. It creates a virtuous cycle. The lower our cost of capital, the more royalties we buy. The more royalties we buy, the lower our cost of capital. We just keep going around in that cycle, and that creates tremendous shareholder value. And the market's embracing that. So you talked about our share price performance. They're embracing this roll-up strategy. We're becoming a more substantial part of the GDXJ index, which we joined about a month after our IPO. So the bigger we get, the more index and passive buying happens, the higher our multiple goes, the lower our cost of capital. Again, that virtuous cycle as a result of achieving that scale through M&A.
Incredible. But it also gave you new exposure to some coveted mining areas in Canada, didn't it? Especially one of them. I think this was really the golden target, wasn't it? Canadian Malartic.
Canada's largest producing gold mine. They produced 700,000 ounces from that one mine last year. And it's operated by Agnico Eagle and Yamana, 2 of the biggest operators in Canada. And Agnico Eagle is actually my old haunting ground. I worked at Agnico as CFO for 12 years during their formative years when we grew from 100 million market cap to, when I left, it was 10 billion market cap, by building mines in that very region. We built 3 mines in the 12 years I was there, within 30 miles of the Canadian Malartic mine, and 2 of them are still operating. So Agnico is an experienced operator, and the Abitibi Greenstone Belt, that gold district, is one of the most prolific gold districts in the world. And so really the way we look at Canadian Malartic is this is our gold strike. And the reason I make that reference or allusion is because Gold Strike is the royalty that provided the foundation for Franco-Nevada, the largest market cap royalty company in the world. This has that kind of potential, that kind of scale in the right jurisdiction. And I should add The Quebec is the top-rated jurisdiction in the world, as rated by the Fraser Institute for mineral potential, for low regulatory risk and low political risk. And we will have this asset as a result of this three-way merger with Abitibi and Golden Valley.
Does this make your balance sheet even stronger?
It does. On a pro forma basis after this deal, we're going to have about $50 million US in cash, an undrawn credit line of $25 million US, so $75 million of capacity, but no debt on the balance sheet. It's squeaky clean. Simple share count, 72 million shares outstanding. On a pro forma basis, it'll be about 120 million shares after this deal, but no debt on the balance sheet and a great cash balance. So we're really equipped to continue to grow.
And you must have an even better management team from all this too, right?
Yes, absolutely. I mean, what we've done in the acquisition of Ely is not only acquired their 80-odd royalties, but brought in the intellectual capital that built that company. The founders, Trey Wasser and Jerry Brofman, have joined the company. Trey on our board, Jerry as part of our management team. And what we love about what Jerry and Trey have done is they generated virtually all of their royalties internally, which is to say that Jerry's a prolific prospector based in Nevada. And what he does is he stakes exploration claims for next to nothing. He farms out the properties to juniors and to producers to invest in the exploration. He takes a royalty back. So the cost of acquiring these properties is next to nothing, and they provide us a steady pipeline of opportunities going forward. Similarly, with the acquisition of Golden Valley and Abitibi, we are actually bringing on Glenn Mullen, who's the founder of both of those companies. Glenn, like Jerry, is a prolific prospector, but in Quebec. So he'll be pursuing the same generative exploration and royalty generation model in Quebec that Jerry's pursuing in Nevada. So here we have 3/4 of our asset base in the two best jurisdictions in the world, both geologically and from a political risk and regulatory standpoint, as rated by the Fraser Institute. Fraser Institute is an economic think tank based in Canada that rates mining jurisdictions globally and has perennially rated Nevada and Quebec as the two best jurisdictions in the world. The other potential opportunity here, and it's not just true of Canadian Malartic, but across our portfolio generally, but Canadian Malartic in particular, Agnico and Yamana today are investing $1.6 billion in that mine to build an underground mine. Right now, all the production for the last 10 years has been from open pit. So they're following the resource at depth. They have 4.5 million ounces of gold reserve, and they see 6 to 8 million ounces of additional potential at depth. So as they build out the infrastructure for production underground, and they're sinking a shaft and other infrastructure there, they're going to open up the lower horizons for exploration drilling. And that's the beauty of this greenstone belt, is you really are limited in terms of what you can delineate from surface drilling, because you can't drill, beyond several hundred meters from surface. But as you open up and build infrastructure underground, you get underground drill setups as well. And you start to drill these deposits at depth. So a great example, an illustration, is the LaRonde mine, which is the flagship mine for Agnico Eagle, which is located just 30 miles away from Canadian Malartic. So that started out as a small zinc mine back about 15 years ago when I started at Agnico Eagle. Then they started drilling it from underground. And that small zinc mine turned out to be the largest gold-bearing volcanogenic massive sulfide deposit ever discovered, with 6 to 8 million ounces of reserve and resource, including what's been mined at this point. So started as a small zinc mine. When you get that underground infrastructure in place and you're able to drill at depth, these deposits tend to blossom at depth and grow geologically. And that's the beauty of the royalty model. We have a royalty on the property. So as the resource is added to, that royalty just perpetuates itself, it grows. We provide full leverage to the exploration upside to our shareholders without the exposure to operating capital cost inflation risk, because our royalty is just on the top line on the revenue.
Well, this is exciting to hear, David. No guarantees, of course. This is a speculative investment, but royalties, like Gold Royalty Corp, do help mitigate the risk with a wide diversification of mining assets. And 191 is a lot. It's probably going to keep growing too.
Absolutely.
How can potential investors get a hold of you, David?
Well, we're on goldroyalty.com, and you can subscribe to our newsletters and news releases on that. And we're GROY, GROY on the New York Stock Exchange American.
That's right. I'll include all that info in the description of the video below. Check them out. You can buy this stock with all kinds of brokerage accounts. You can even use Robinhood an app to invest if you're interested. If you decide to buy in on Gold Royalty, you will be joining the likes of Eric Sprott, right?
He's our second biggest shareholder. He was Ely's biggest shareholder.
Yep.
And as a result of the share for share exchange, he became our second biggest shareholder after Gold Mining, our founding shareholder. And so, we've diversified our shareholder base and invited some really exciting people into the shareholder role.
You have great inside ownership. Love that. And I just think it's worth checking out. I'm going to do more than just, put it on my watch list now. I'm very interested in what's happening at Gold Royalty. So thanks again, David, for joining. Really appreciate it.
Well, thank you for having me on. I really appreciate it as well.